The Governor of the Bank of Canada, Tiff Macklem, talking about inflation trending towards 3% this year, possibly towards 2%, the target rate by 2024. But getting back to the currency reaction, Critty, there is a view right now that the Bank of Canada might cut rates by the end of the year, and Tiff Macklem did push back on that idea. Have a listen to what he had to say.
What I can say about our deliberations is that based on the information we have today, the implied expectation in the market that there are going to be that we're going to be cutting our policy rate later in the year, that doesn't look today like the most likely scenario to us.
And let's bring in BNN Bloomberg's David George-Cosh, who has been covering the Bank of Canada decision. And so on the one hand, painting a picture of a possible soft landing, and then, as we just heard, pushing back on the idea of a rate cut possibly later this year.
Yeah, certainly. And what we saw in terms of that inflation focus was that while inflation in Canada is trending downward from the high of 8% that we saw last year to around just north of 5%, the service part of inflation here in Canada remains quite sticky. And that's because of the strong jobs market that we have here in Canada. 7 consecutive months of jobs growth here, and that's a little bit of a concern for the Bank of Canada. They're not Governor Tiff Macklem. They're not necessarily seeing too much slack in the Canadian economy and in the Canadian labor market as well. There was also some upward revisions in terms of the economic outlook here in Canada as well, with the Bank of Canada's quarterly monetary policy report. All things to say is it looks like economists and the Bank of Canada would largely see rates still on pause for the remainder of this year. Although, to your point, there is some outlying economists that are calling for a rate cut, but it looks like we're not necessarily going to see rates fall below that 4.5% in 2023.
What is the Bank of Canada really taking their cue from here? You mentioned the labor market specifically, but when I think Canada, I think John Ehrlichman has kind of created this association in my brain. I think oil. And if we're looking at oil kind of getting near the 90s, at least on Brent crude, what does that mean for an economy like Canada that's so exposed, to commodity prices?
Yeah, Critty, I think one of the big wild cards in today's monetary policy report was the focus on the global economy, how we saw a stronger China economy going forward, according to the Bank of Canada, but also weakness seen in Europe and the United States. That's going to play a part into how oil prices fare over the next 2 years or so. But at the same point, imports and exports, in terms of how they contribute to Canada's GDP, are looking to be kind of a drag in terms heading into 2024. So that's going to be an important part of seeing how Canada's economy is able to stick-handle itself through a weakening global environment. That being said, with the Canadian dollar at around $1.34 US or 74 cents Canadian, that weakness relatively to other global currencies should help Canada's export economy help to bounce back from any sort of doldrums that it may see in the coming 12 to 18 months.